we've had a bit of a roller coaster week on U.S.-China relations with the clear signs today that things are, at least from Trump's rhetoric perspective, on the upswing. We've seen Trump in a couple different forums today, including just about an hour ago at the White House, offering really kind of optimistic commentary about where things stand with China, at least for today. He, for one, this off again, on again meeting with President Xi Jinping of China and South Korea is now apparently on again. Trump said just a little bit ago, it looks like it's going forward. He also raised the possibility of some sort of agreement when the two leaders gather. They're set to talk on the sidelines of a summit in South Korea at the end of this month. Treasury Secretary Scott Bessent also announced today that there's going to be a kind of a series of talks leading up to that meeting. The first one is going to be actually this evening here in Washington on the sidelines of the IMF annual meetings. And then there'll be a follow-up next week at about a week's time in Malaysia. This is between Bessent and China's vice premier, sort of the two top trade officials there. Overall message here is things are looking good, and it comes a week to the day after Trump kind of surprise markets to the downside with this idea of a 100% tariff, an additional 100% tariff on China over rare earth minerals and supply chains that China is looking to restrict there. Worth noting that Trump didn't take this 100% tariff off the table today. He even discussed moving it up ahead of the November one that he's promised. But the overall message you're hearing from Trump and Bessent for today, at least, is that things are looking on the upside. The relationship between Trump and Xi, they're confident at least, can kind of bring the sides together and at least maintain the status quo for the time being.
And Ben, while we have you, we know Vladimir Zelensky in Washington today with President Trump. You know, after Ben Trump's remarks, Russian oil exports, India yesterday, what did we learn today?
Yeah, we learned a bit today. So this meeting, as you mentioned, was Trump with the Ukrainian president talking about the war in Ukraine, with oil clearly a big element of it. As Trump has talked about this week, Trump claims that India is going to stop its purchases of Russian oil, which would then pressure an end to the war. If that goes forward, it's a very significant economic lever to use against Vladimir Putin and Russia because of how reliant Russia is on oil revenues. Trump reiterated that claim today. He talked about how India, in his view, has already de-escalated, even as Indian officials aren't going quite that far. There is evidence that Indian suppliers are buying a bit less Russian oil, and that's going to continue. But there's no promises from that side, at least, of zeroing out. But this is clearly a lever here. Zelensky was also talking about oil, talking about meeting with energy companies for infrastructure projects going forward. So there's a real tie-up here between the energy diplomacy, the tariff diplomacy, all these kind of things intertwined, as Indian officials are also in Washington this week, just to make things even more complex, with at the IMF meetings to talk trade as well with the Trump administration. They're trying to get a 25% tariff over Russian oil lifted, and clearly both sides are trying to kind of find a middle ground there.
Treasury Secretary Scott Bessent saying Wednesday that there is a possibility of extending the tariff truce between the U.S. and China. The deadline before sweeping tariffs of over 100% additional go into effect is November 10th. While President Trump and Chinese President Xi are set to meet later this month, my next guest says a comprehensive trade deal nowhere in sight. I want to bring in Shahzad Kazi, China Beige Book International Managing Director. Shahzad, good to see you as always.
Good to see you.
So it doesn't feel like, it feels like the two sides are getting further apart with this latest surge in rhetoric. Bessent, in a press conference the other day, really coming out with some pretty strong words for the Chinese. What's going on here? What happened?
You know, what happened over here fundamentally is, first of all, there was no real phase two process, even though there was a lot of optimism building in recent weeks. There's absolutely no march towards that deal that was taking place. Then, of course, you have commerce coming in and refining export control rules by putting in that 50% ownership rule, I guess I should say. And that really caught the Chinese by surprise. They were legitimately upset by that. And they respond, of course, very aggressively with their rare earths.
Okay, remind me which export control rule this was, because it's hard to keep track of with the back and forth.
So fundamentally what this says is that if you are a Chinese entity that is not supposed to be receiving US-made chips, and you have a 50% ownership in another entity, that entity would also be blocked, right? So this was further fine-tuning and making sure that the export controls on the books actually make sense and are implemented in a sensible format. The Chinese saw this as a new action against them, and were just incensed.
Now, the playbook that we have become accustomed to, the markets have been accustomed to, is Both sides kind of go at each other. Usually the U.S. has been the aggressor, so to speak, with President Trump coming in with these dramatic pronouncements. Both sides sort of ratchet it up, and then you get that de-escalation. Are we still there? Is that, knowing what you do about the Chinese economy and how China operates, are we going to see that de-escalation this time?
I don't question that a de-escalation isn't possible. I think it's quite likely that, especially in the lead up to APEC, that you see both sides letting things cool off. But I think what we are from a longer term perspective over the next several years, I think we might just see a repeat of this over and over again, because either you just cannot bridge the gap between the two sides, which is what I firmly believe, and at the same time, you also don't have sort of this conversation taking place that we're going to decouple here and we're going to try to work together with each other here. So you're left with this mess that markets are constantly suffering as a result of.
Why don't you think we'll be able to bridge the gap? Because we both are, as you say, we're still not decoupled. We're pretty reliant on each other economically. And at least in theory, we should both be prospering together. It's in everyone's best interest for us to work together.
Well, I think the big problem is that from the Chinese perspective, that we finally come to a decision that says that we cannot just hand over all our latest technology to China. That's something they don't like. On the other hand, of course, we'd like China to rebalance its economy and not artificially keep prices low and dump its products abroad, which is not just a U.S. problem, but a global problem. And China will tell you all day long that they intend to not do so. But certainly that's been their economic model and continues to stay. I think those just right there are two of the biggest things keeping both parties in this conflict.
So what are the implications of all of this? So let's talk about the Chinese economy first. That's where you focus your attention. We did talk to a Wall Street veteran the other day who likes the Chinese market and who says, they're willing to put stimulus in no matter what happens with U.S. trade talks, and the economy's on solid footing. Do you agree?
The economy is actually doing much better than the perception has been. The summer of slowdown narrative, I think, is rather misplaced. If anything, we've seen the Chinese economy post a recovery over the second quarter, into the third quarter, into the summer. Now, we'll see if that carries on into Q4, but certainly, parts looked stronger than what the market narrative had been.
And so what does that imply also for negotiations then?
I think it implies that you're looking at a Xi Jinping, you're looking at Beijing that are not panicking.
And so does that mean, between the U.S. and China, that I guess I'm just still trying to figure out how all of this plays out.
Yeah, I think, what you get is these series of mini truces taking place. I could even see the two sides working towards a very narrow phase 2 agreement. I think if the Chinese come to the table tomorrow and make pledges to start buying soybeans and agree to perhaps purchasing some Boeing airplanes and so forth, and roll back some of their more egregious export controls that they've rolled out, or clarify that they mean it, that civilian users will be fine, et cetera, I can see there being a phase 2, but the process to that will be, I think, incredibly messy, and I don't know how long that deal will last before the next blow up.
And in the short term, you mentioned APEC. That is the meeting, the Asian leaders meeting, where Xi and Trump had been set to meet. Then Trump said they weren't meeting. Besson says they're probably still meeting. Do they meet, and what should we be watching for at that meeting?
I think from the Chinese perspective, they're going to not want to do anything very televised, getting the two presidents together in front of cameras. So from a public standpoint, we may not hear much. Do we just get a handshake? Do we get an understanding that says let the two sides continue working on resolving some of our issues? I think the Chinese side is not going to be wanting to get in front and having to see Trump making too many comments, even though the president may actually prefer that.
Our expectations should be low, in other words.
Absolutely, expectations should be very low on this.
And then finally, picking up on what we were talking about with the president saying India has agreed to stop buying Russian oil. Do you think China goes there? Is there any chance of that?
Absolutely not. And I don't think we're even going to push them.
Okay. Shahzad, great to see you. Great to get your perspective, as always.
Time now for our stock of the day, rare earth stocks. MP Materials, the largest rare earth producer in the Western Hemisphere, is down now after 2 straight days of gains and closing Monday at a fresh record high. The sector, though, has been up since Friday on reports that China is adding new export restrictions on rare earth minerals. That's stoking another round of trade tensions between the world's 2 largest economies. China controls nearly 70% of global rare earth mining and close to 90% of processing capacity. That means any policy move from Beijing can quickly ripple across industries, from electric vehicles and clean energy to even the chips that power AI. Still with me is my roundtable for today, Lale Akonar, Michael O'Rourke, and Brooke DePalma. And Brooke, I want to start with you here on the moves that we're seeing in some of these rare earth stocks, because a lot of these policy-linked trades, they're gaining a lot of attention this week.
Yeah, we've seen some major moves when it comes to these rare earth stocks over the course of these past few days. We had critical metals jump more than 36% in the pre-market trading. U.S. rare earth was up about 11%. MP materials up about 8%, as well as others like Energy Fuels and Neocorp also rose about 14 to 15%. And this really is based upon this notion that Beijing's new export controls on rare earth are really designed to essentially force the U.S. to drop these restrictions on selling these chips to China. And so it really is part of this larger conversation undergoing and the impact that these rare earth restrictions could have, and investors really looking to gain when it comes to these specific stocks as well.
Now, Lala, you've said China's rare metals ban could dampen the AI revolution. Walk me through some of that concern and the broader implications there.
Sure. I think, first of all, the market does think that actually this could trigger a fear of supply squeezes, if you will. The fact that they're obviously very dominant in these exports. And also the market is pricing in that the US will simply have to accelerate its efforts to build an independent rare earth supply chain. And these are very important materials, obviously, for magnets used in EVs, in defense, in AI, and in critical tech. And therefore, you could see that the market is being a little cautious in terms of how they price in its effect on the big tech. I also see investor sentiment being affected by this notion of capital rotating into the more real assets, which have strategic utility, and hence the capital flow that we are seeing at the moment. But yes, I think the volatility does tell us that the market is concerned about what it would mean in the short term for the AI trade.
And speaking of volatility, crypto has been on the move quite aggressively since these renewed U.S.-China trade tensions. And this is coming as gold is at a record high. Michael, you've been writing about the so-called debasement trade, which is essentially investors losing confidence in central banks and shifting towards hard assets. Is crypto part of that story at all?
Well, it's been part of that story and been part of that trade. But I actually think that trade is probably has a lot more hype to it than substance. So, like I said, there are underlying notions there, whether it is, expected central bank easing, whether it is, these geopolitical concerns, whether it's fears about devaluation of the dollar or, American exceptionalism being over. What we've seen is this euphoric run, especially in things like, gold and silver, obviously both hit another set of record highs this morning. But, I think a lot of this, goes back to the pandemic in 2020, when the central bank wound up doing a massive QE program, more than doubling its balance sheet. And where we are today is we're reversing that process. You just don't see it on a daily basis. But that has, that lack of confidence in governments. And again, that goes from everything from the elections we see to government shutdowns, the inability for governments to pass budgets has fueled this trade thus far this summer into this fall.
China imposed sanctions on 5 of South Korean shipping companies' U.S. subsidiaries effective immediately. This comes as the U.S. also begins collecting steep fees from Chinese ships coming to the U.S. imposed under Section 301. All of this, the latest moves in the tit-for-tat trade war that sent stocks tumbling Friday and again today. I'm joined by Terry Haynes, Pangea Policy founder, and Nazak Nakhtar, Wiley Rain LLP chair, who served from 2018 to 2021 in the Department of Commerce as Assistant Secretary and Undersecretary. Thank you both for being here. Nazak, let's start with you. I'm curious what you make of this sort of reignition of these tensions that seem to be set off by China imposing these new rare earth mineral export controls. What do you make of that, and what was behind both the move and sort of the timing of the move?
Yeah, very good to be with you. I actually don't see this as a reignition. China last summer started imposing export restrictions on critical supply chains, critical minerals that we need for the production of semiconductors, other types of critical mineral materials. And over the time, it's been expanding its export controls. And remember, we had the Switzerland negotiations in 2025, the London negotiations that President Trump and his team had in 2025 in London to free up some of these exports. As China's export controls got bigger and bigger, that expanded to more and more critical minerals and some of the strategic materials we need. And China essentially never let up. It maintained its export controls despite these negotiations. We still weren't getting the feedstock we needed. So I don't see this at all as a Chinese reignition. I actually see this as a continuation of Chinese policies that, one, it instituted just about a year ago, and two, it has been expanding and really never letting up on. With respect to the timing, look, China, what it does, it prepares these measures, and whenever it sees the U.S. sort of taking an advantage, getting an advantage on the global scale, moving with respect to more restrictions on China, China needs to save face. That's very, very big for the Chinese government. Save face. So the U.S. makes a move, whether it's export controls, whether it's the Gaza peace deal, et cetera. China makes a counter move to show the world that China is here, and it is now dominated power, and it is now able to rival the United States.
So, Terry, what does that imply for whether progress gets made between the two?
Well, good morning, Julie. And I think that there won't be progress for a lot of months to come, certainly for the foreseeable future. It's frankly not in either country's interest to have any long-term progress. What you've got here is, picking up on the last point, is you've got the sum of a Trump-Gaza brokered peace that included an awful lot of help, interdependence with the major Gulf powers. You've got the U.S.-Argentina bailout. You've got Russia under a lot more pressure from oil to Ukraine attacks. All those things combined are net defeats to China's interests and to its client states' interests, Russia and Iran and the proxies specifically. So, they're not inclined to play nicely with the United States on trade and haven't been for the last 6 months. The markets have talked themselves into the idea that progress is being made, and it's in the United States' interest to continue to have an outstretched hand. But at the same time, neither side is really interested in wanting to move forward here. And among other things, China's reminding us all of that.
I mean, it feels to me like the markets are less concerned with progress than they are about steps back, right? That kind of is the thing that set the market off, that we thought this stuff was at least happening in the background. There was no news. No news is good news. And then you get this post from the president. So, Nazak, where do we go from here? What does this all mean now for these negotiations?
Yeah, I mean, that's the key question. I'm glad you posed that. It's two schools of thoughts. One, there's a camp in the administration in Washington, D.C. broadly that believes that negotiations are still possible, right? And there's another camp that said, look, no, look at what we've done. We've been trying to negotiate, and China actually hasn't moved an inch. And so, maybe China's ultimate end game is to not negotiate. And if that's the case, then the U.S. government really has to double down on looking at critical capabilities. China has export restrictions on battery materials and lithium-ion battery technologies, industrial diamonds that we need to make really everything. Shipping, as you just talked about, critical minerals, alloys. We know where China has a stranglehold over our supply chains. We've known for this for over 10 years. And yet the U.S. government, across all sort of sections of the U.S. government, has been a little bit slow into figuring out had to really double down and build our domestic capabilities, which includes Congress appropriating money and the administration, the executive branch moving swiftly to give companies who want to invest in the United States that money. And then again, shield these investments that are now growing in the United States from predatory import competition, China turning around and dumping goods in the United States. This requires a holistic approach. It requires the executive branch to work closely with Congress. And even if we're able to negotiate our way out of this a blip, rest assured, this is China's card. This is the card that China will play over and over again to discipline the United States and the rest of the world. And this time we need to really get our act together and not be vulnerable.
Well, Terry, us not being vulnerable in these negotiations might open up the market to a lot of vulnerability if the U.S. is indeed going to play tough and hold the line. And the market has gambled successfully so far on the so-called taco trade. I know you've got another acronym, but the idea being that we do abandon the harshest tariffs, even if it's at the 11th hour.
Well, sure. The markets are very binary, on sentiment on this in this area. Either everything is more or less going along swimmingly, or there's the prospect of a crisis, and they swing back and forth. They've swung back and forth just in the last 24 hours or so. Yeah, I suggested, I think the taco thing is dumb, because if you suggest 100% and you get 30%, it's, oh, well, he chickened out. Well, he got 30% and applied it, and you haven't paid attention. My acronym was more like BUSAFE. Both usually step away from escalation, and that is part of what's going on here. Both sides judge, and I think China judged first, that for the reasons I mentioned, that it was time to shake things up a little bit, and, as was said, remind people China was here and that they have interests, and that's all well and good. But the administration so far is not interested in backing off. I do think they end up kind of moderating this in the end, but we will go back to this kind of cold trade peace that exists. But if anybody in markets thinks that either side is interested in actually finalizing a negotiation and moving past all this, I think they're dreaming.
Terry,
I want to add that this.
Yeah, please.
I want to add that this tit-for-tat sort of countermeasure is just not productive. The U.S. government really has to just understand this is a vulnerability, and this is the card China is going to use against the United States over and over again. And instead of wasting so much energy on tit-for-tat negotiations, really double down and build the capabilities we need at home, so we're not going to be in this position to be in the next time.
Sure, but that takes years, right? So it seems like they're on the path to doing that, but it's not going to be next year or the year after that. It's going to take a while.
You know what? We've made a lot of progress. U.S. industry has made a lot of progress stemming from the work that was initiated in the first Trump administration and carried through to some extent in the Biden administration. We're just a few years away from developing scaled magnet technology in the United States. We've got incredible battery investments in the United States, investments in super hard materials. Those are the industrial diamonds. I would actually say in about 2.5 years, we will be well on our way. So there's a small gap period to solve, but I think the U.S. has been doing a lot better than folks give it credit for.
Well, investors are watching U.S. and China trade tensions very closely, but some argue the latest standoff won't break market momentum. Our next guest, Michael Kantrowitz, Piper Sandler chief investment strategist, has said don't trade the headlines, trade the cycle. Michael, always great to see you on the show. So I'm looking here. I got green all over the place today, Michael. I mean, obviously on Friday, U.S.-China trade tensions, we have the freak out. Was that just a blip, Michael? And as investors, listen, should we just look through that, past it, full steam ahead here?
Well, I would say the fundamentals of the economy remain are a tailwind for equities. Of course, it's been a while since the markets have been negatively surprised by any tariff headline news. And what we've observed is that the market not only is going to respond to news, but ultimately, whether or not the market follows through with that is ultimately if those issues come to fruition. So really right now, it's really headline news. Nothing explicit time and date has been set. If anything, we've heard obviously positive announcements from Besant and President Trump over the weekend, and it sounds like they're going to be talking. But just the recent behavior and pattern of these tariff headlines, I think, has been quite diminished But obviously Friday was a bit of a shock in a market that's been up a lot. So I think people just maybe use it an opportunity to take profits, but I don't think President Trump's going to do something to disrupt this bull market.
So broadly, Michael, you're still constructive on this market. You're broadly in that camp that says, listen, earnings hanging in there, economy's hanging in there, and the Fed's cutting. Stay long.
Earnings look great. When we look at the breadth of earnings, small cap earnings estimates are at a 2.5-year high. It's been part of the story within that space, which is why it's lagged. The earnings estimates have been going nowhere up until about 3-4 months ago, and now you're starting to see broad-based improvement in earnings breadth, something that has severely lacked in the last 3 years. So we think that's the early signs of a major change in the economic cycle. And we expect to see, as we go into 2026, these declines in interest rates from the short end. We've seen an easing cycle for over a year. Mortgage rates are at the lowest in a long time. Still high, but they're down, and that's all we need. So we expect to see better housing data, better manufacturing activity, and a better, broader economy in 2026.
Michael, I had an economist on the show recently who said, listen, as long as this government shutdown continues, the Fed isn't getting that hard data they want. And the longer it goes on, he says the greater the odds that at this next meeting they don't cut. I'm just wondering what you make of that theory. And if they didn't cut, how you think the markets might respond.
Yeah, I'm not so sure I buy into that. There's plenty of other data besides government data that the Fed can look into every day, every week. So I'm not so sure that they're just going to not do anything just because there's a bit of an absence. I mean, there's been a trend in the labor data for now, arguably 2.5 years, but it's been very clear now in the last few months, given all the revisions we've seen to the data, plus just some soft ADP data. And obviously when we were getting the NFP data, that data were soft as well. So I don't think the Fed wants to surprise the market. Thus far, Powell in his term really hasn't, or at least not since COVID. So I wouldn't bet that the Fed's going to pause because of an absence of information. I think they'll just take the information they have that is known and act accordingly. And I think they're probably going to cut once more. Cut in October.
What about, I want to switch gears, just talk to you about the AI theme as well, Michael. We heard today OpenAI partnering with Broadcom. They're going to work together, it sounds like, develop these 10 gigawatts of custom AI chips. AI boom, Michael? AI bubble? What are you telling clients?
I'd say it's more of a boom than a bubble. When we think of bubbles, we think of valuations going to the moon. And of course, there's a lot of froth today. Anytime you're in a market that's at all-time highs that has seen such strong returns in the last few years, you're going to get a lot of speculation at the fringe. But the biggest companies in the market today are printing money hand over fist, which is quite a contrast from the backdrop in 99 and 2000, when the bulk of the returns in the NASDAQ and the tech sector were really coming from multiple expansion. Here's a fun fact. In the last 3 years, the S&P's multiple is up, the small cap multiple is up, but the multiple is not up, the Mag 7, it's down about 20%. So it's all been earnings driven thus far. And if we're back into a easing cycle, I could tell you from studying bubbles throughout my career and reading a lot about them throughout history, is they don't pop when you've got easing money conditions.
Let me ask you, Michael, I mentioned the government shutdown. I'm curious what you're telling clients about that. Listen, as investors, as long as we think it's not going to impact corporate earnings, should we just look through it?
Yeah, I don't see it impacting corporate earnings, nor do I think it's going to last that long where it's going to get to that point. Sure, it's not going to be a week and a half or 2 weeks, which is I think what most people thought it would be. But even if it drags on a little longer, I think looking at all the different macro issues today, that is not a big one right now for the markets. And there's really no clear transmission mechanism into markets and into corporate earnings. Certainly not right now. If this drags on, months and quarters, then maybe we can consider that. But I think it's way too early to be concerned about that issue. Finally,
Michael, I'll just get you out of here. Broadly, I'm just curious, where do you see the opportunities in the market? What are you screening for to own and to avoid?
Yeah, well, I'd say where we're most at a consensus, and this has been a theme of ours for a couple of years, that rising unemployment is a bullish catalyst for equities, and that is just not a idea that people are really they think is intuitive. And obviously, it's counterintuitive to some respect because the last two recessions of '01 and '07, that was quite the opposite. But actually, if you look throughout history in periods of rising unemployment, you actually see stocks go up more often than they go down. So we're seeing that the last 2.5 years. So we would be recommending areas that would be typically labeled as early cyclicals and other cyclical areas, financials, banks. I think home builders do well in a backdrop where the labor market's soft and rates stay low. Some consumer discretionary areas that have really been kind of underperforming. So, I think this is a time where the laggards can start to see some relative performance, something that's, again, been absent for the last several years. I don't think we're going to be seeing a big economic boom coming out of this, so I still think you want to be selective. But I think we're seeing a broadening into 2026. And I know people have been calling that for years. This is the first time we're making that call, and we see a lot of green shoots that support it today.
Michael, always good to see you on the show. Thank you, sir.
Yep, my pleasure. Take care.